S&P 500 is one of my favorite ways to invest my money, and I always recommend it for beginners, but even for people intermediate and who have already a larger portfolio, to automate it, dollar cost average every single week or month into it, and overall your wealth will grow as it has done historically, anywhere between 8 and 10% year on year over the last 30 years or so. So I think a real truth and tried investment vehicle. But still, every time I talk about it, there are a lot of people writing me saying, Kai, there are much better ways to invest your money. And honestly, I'm not really much of a debater. I don't like to waste my time arguing with people online, but that's exactly why I like investing, because ultimately numbers talk for themselves. And that's why I thought in this video, I'm going to be comparing the 10-year performance of the S&P 500 to some other investment vehicles that people can invest their money in and see how it did over time. Hopefully after this video, you can make a more informed decision as to what could be potentially the best investment for your money. Right, so for this comparison, we're going to be using a website called Seeking Alpha, which is honestly one of my favorite tools to do any kind of stock research. I even have all my various portfolios listed over here. My interactive brokers automatically sync, so every time I buy and sell something, it's going to be reflected over here. I really get some deep dive analysis on all the various stocks and holdings that I have. So really powerful tool. If you want to check it out, I have a link down in the description below, and you'll get a significant discount using my link, which will definitely save you a bit of money. But let's kick things off by comparing it to the biggest asset in the world right now, which is still gold. Actually, the market cap is 15.8 trillion, so significantly larger than the biggest company in the world, Nvidia. We'll come to this a little bit later. So let's compare the performance of gold versus the S&P. So once we go back again to Seeking Alpha, I can see over here a number of indices that people follow. One of them is of course gold. So I can click in gold over here, see the price right now, 2,339. So obviously, from here, I can see a nice increase, especially last year, up 20%. So really nice to see. However, let's look at the 10-year performance, going into charting over here, and then zoom out to the 10 years. And I can see over here S&P 500 versus gold. And well, you see already quite a difference in performance actually, quite staggering. I mean, more than twice the returns in the S&P, 180% versus 77%. And that's despite, obviously, we've seen in 2020 a major reset in the S&P, but long term, it really outperformed gold tremendously. Now, obviously, I'm not suggesting that people, compare investing into gold to outperform the S&P 500, not at all. But ultimately, you still have to think about, how far can your money go if you invest into something, right? And of course, we have seen years, obviously, in that particular year where the S&P retraces, but over the long time period, if I go to max, even longer, you can really see a major outperformance over here. That's now going back all the way to 1994, almost 3 times the returns with the S&P versus if you would have invested in gold. And honestly, that's actually only part of the story, because if I go back to the 10-year chart, this is pure price performance, right? You see here 179, 180% for the S&P. So that's the price performance, how much the price increased over the time. What it doesn't take into consideration are the dividends. Unfortunately, I can't show it over here in this chart, but if I pull up one of the most popular S&P 500 ETFs in the world, the VOO, I can go into momentum over here, and then I can see the total returns, right? So that's the 10-year total returns. And obviously you can see the same with the S&P, basically 236%. So I get another additional 50% returns on top just from the dividends, despite the dividends being rather small. As you can see right now, the S&P pays around a dividend of 1.27%. So very little, but still over the periods, over those years, those add up to an additional increase, right? So now I'm comparing the 77% I had previously on gold. You see here the price return we had before, 179, but total return includes the dividends. So here we then have the 236. So major difference. And yeah, if I would go out to max since 1994, as I've shown you before, now it's 2087. And previously, I believe for gold, it was 400 something. So more than 5x the return. So really a staggering difference. All right, what about bonds, right? A lot of people like bonds. I've never been a fan of bonds, but let's have a look. The US 10-year treasury, right? A lot of people like to invest into that because it seems like a very trustworthy bond to invest in. Now, obviously, again, you invest into bonds for different things. I get it, right? It's like similar to interest to secure a high interest, because it doesn't really, capital appreciate much. You're just securing yourself the interest, but still out of interest. Let's have a look how it would have compared if I compared those two. And if you would have held it for 10-year period, you would have returned 66.94% versus once again the 179 or 231 if I really factor in the dividends, which you should. So it would be a significantly higher return and significantly worse for investing into the bond. Now, once again, I understand that people may want to have some money in bonds, but still at the same time, for me, it's really not that convenient because you lock up your money for quite a number of years, right? To get out early of those bonds, sometimes there's penalty or sometimes you can't even do that. So it's not really flexible, right? If I have it on my interest saving accounts like Lightyear, Trade Republic, Trading 212, I can withdraw my money anytime. And right now I've been getting up to 4.2% interest on my money, right? Which is really attractive. And as I said, I can withdraw it anytime. Now, of course, bonds, they lock the rate for a long period, right? So even if interest rates starts going down, we've seen that with the ECB recently, those bond rates will still stay up rather high. You can see how it developed over years. So you will lock in basically a high interest rate. But once again, for me, it's really not that attractive. I think there are much better investments out there. Right, with this, let's look at another ETF that people really like and invest in, and that's the MSCI World ETF. So basically, that's another index similar to the S&P 500, but this one focuses on global stocks and companies around the world and different markets, really a global approach. And it's the iShares one, so it's issued by BlackRock, so really solid, trusted player out there. Let's see how that one compared to the S&P 500. Surely it must have performed better than some of the asset classes that we just looked at. So let's see, 10-year period over here. And well, to my surprise, once again, it really, in my eyes, clearly underperformed, right? 146% versus 236 total return. Because of course, that particular ETF also does pay a dividend. You can see over here, it pays a 1.54% dividend, so slightly higher even than the S&P 500. But well, it's still underperformed. So in my eyes, again, some people like to invest because it's diversified. But actually, when you look at the holdings, you can still see the top 10 holdings are by nature, by default, US holdings, right? You can see that clearly over here. So obviously you still then have other countries in there, so you do diversify a little bit, but majority of it is still going to be US based. But at the same time, you have other countries that have performed poorer, and that way it pulls down your performance. And also keep in mind that your expense ratio, basically the money you pay to BlackRock to manage that fund, will in most cases be higher. I'm right now paying 0.03% on my S&P 500 ETF, which is actually the cheapest one in Europe, so it's really great. But these ones, they sometimes 0.2, 0.25%, and obviously that comes out of your own profitability. Let's compare it to an individual company. And here I'm taking the S&P 500 back from 1990s. So in the 1990s, the biggest company right then was ExxonMobil. I don't even know how many of you remember, but ExxonMobil is a big player in the oil industry, right? So at the time, it was the most valuable company in the US and arguably in the world at the time. They still are a big player. You can see right now is the 13th biggest company in the US. You can see that over here. So let's have a look how they compared versus the S&P 500. If I pull up ExxonMobil over here, well, sadly, as well, not too impressive. Quite the opposite, actually. It even underperformed gold. As you remember, it was around 70, something upwards of 70%. Here in total return, that's including dividends, it returned only 66% over that 10-year period. That's a major difference. You can see really how the growth was significantly slower. It still grew, obviously, but for a while it really dropped. And that's obviously really dependent on the oil price and on global macroeconomic factors. The dividend yield of 3.47 looks definitely attractive, but overall the total returns, not so much. Let's look at another individual company. Coca-Cola, currently the 29th biggest company in the US and one of the few dividend kings, which basically means they have been paying and growing the dividend for the last 50 years or more. In fact, they have done so for 61 years, so quite significant. And right now the dividend is 3.1%. So surely they must have been having similar performance like the S&P 500, right? Well, I'm very sorry to disappoint you, but unfortunately also not. You can see they, over a 10-year period, returned less than half of what the S&P 500 returned, with only 104% something, and that's total returns including the dividend. And honestly, I used to be quite a big Coca-Cola investor. I love the company and I invested into it, but when I saw the chart, I really realized that honestly, I'm missing out and my money is not going as far as it could be going if I would have invested into the S&P. Now, frankly speaking, I could continue this game for a number of companies, probably anywhere from the top 10 downwards. A majority of those would underperform. And that's purely because the top 10 is performing so very strongly, right? Especially Nvidia in recent times. That company alone was responsible for some of the major gains we've seen in the S&P 500 in recent times, and just shows you how important the top 10 is. But as we've seen over the years, the top 10 constantly changes, right? If I go to 2000, you see again different companies over here. Walmart, Cisco at the top, right? General Electric. So I think it's really important, bet on the winning horse, and that way you as an investor will always benefit regardless of who's going to be at the top. But of course, nothing is ever perfect, and surely there are other investments out there that are beating the S&P 500. So let's have a look at a couple of those. And let's start off with the Wall Street darling in recent times, Nvidia, which has really been crushing it. Unbelievable. Now the most valuable company in the world. I mean, unbelievable. Really, really impressive. I would have not foreseen this a couple of years ago, to be honest. And well, yeah, you can see the total returns absolutely destroyed the S&P 500. You can see over a 10-year period, 236% for the S&P versus 30,894% for Nvidia. I mean, if you would have invested 1,000 euros or dollars at the time 10 years ago into Nvidia, you would now have 300,000 euros or dollars. So absolutely mind-boggling. But once again, right, it's so hard to predict. Out of so many other companies that could have performed well, it's exactly Nvidia that had such astronomical returns. So really impressive. And you can see only in the last few years, obviously, that they really picked up. Before it was really neck to neck, more or less. So if you invested into that, great. You definitely outperformed the S&P 500. So credit to you. But again, my question is always, for every winner and outstanding company that we've seen the majority of the S&P 500 companies actually underperformed the S&P, right? So only because of those few winners that you really gain. So if you would have invested and spread your money across different companies, then you wouldn't have seen such astronomical returns. And that's why, once again, I don't think I'm able to predict the next Nvidia. So I'm happy investing into diversified S&P. So next up, we can compare to another popular index, the NASDAQ 100, so the 100 biggest companies in the NASDAQ. And obviously those are very tech heavy, mostly tech companies in there, quite niche down. And you can see they really also destroyed the S&P, really strong performance versus the S&P 500 over the last 10 years. And once again, that's without dividends. So the S&P would gain a little bit more. The NASDAQ not so much because they don't really pay much dividends, very small. So the added over here would be tiny, but overall more than twice the returns if I factor in the dividends over here. And yeah, because we've seen in recent years the tech being so strong, right? But at the same time also the S&P 500, with every year the tech continues to shine, they are becoming more and more like a tech ETF, like a tech index, right? Because once again, the more valuable a company becomes, the higher weighting it will have inside the S&P 500, and therefore you will have more of tech companies represented in the S&P. So again, I'm not investing too much into the NASDAQ right now. I'm not investing anything, but at the same time, I'm happy to see that the S&P 500 becomes more and more tech heavy, and therefore I'll be benefiting as an investor from those gains in the future. Now, of course, another asset class that absolutely outperformed the S&P is Bitcoin, right? I mean, when I look at it over the last 10 years, there's no doubt that it really outperformed significantly. You can see 10,900% return. So still less than Nvidia actually, but yeah, absolutely crazy returns versus the 236 from the S&P. But you can obviously see the biggest growth really came in the beginning. And I think while I believe really I'm a big Bitcoin investor myself, that long term it will continue to grow. However, I think the crazy returns, they're probably not going to be so strong anymore. They will still continue to outperform the S&P 500 in the near future. I'm very sure about that. But long term, I think that difference will come down a little bit, still with an edge towards Bitcoin, but the major difference will come down. But at the same time, you also see major swings over here, right? The S&P has not been that crazy volatile as Bitcoin. That's also something, as the returns will come down, I think the volatility will also come down in the future. But again, that's just my humble opinion. I invest into both of them. I'm really happy with that. Now, of course, you could also compare it to real estate, for example, right? But that's really hard to compare one to one. It really depends on your specific real estate. In my case, I bought a couple of real estate investment trusts, such as Realty Income and Vici, and they pay me a very nice dividend. But once again, the total return really underperformed the S&P 500. When I look into my own actual real estate that I bought and rent out in Dubai, actually, that was some of the biggest returns in terms of monetary return I got from it, because obviously the value I invested was very large and therefore the returns was very large. But in terms of percentage return over a 10-year period, which is around 10 years now that I hold it, actually is still less than I got from the S&P 500. So it hasn't really doubled in value. Still, if I factor in the rent and so forth, it has been extremely profitable for me. But purely based on percentage returns, probably I'm still better off with the S&P 500, right? Of course, that very much depends on where you invest and so forth. So definitely real estate can be very lucrative investment, but it doesn't mean that it necessarily will outperform, especially if you factor in all the renovation costs, maintenance costs, taxes, service charges, what have you. Those can really eat into your profitability. Now, other things people invest in are, for example, collectibles, right? Investing into artwork, watches, or wines and spirits, what have you. But for that, honestly, I don't have enough knowledge. I'm also not very excited about that. And investing investing into art piece, I think once again, it's like finding a needle in a haystack. It's like finding the next Nvidia. It's so hard. Who's going to be the emerging artist and what have you. So for me, it's not something I'm really excited about. I'm sure if I did the same example over here, some of those individual artists maybe outperformed the S&P 500 or some of the watches, but most of them, the majority, surely underperformed. And that's why I think ultimately all roads lead back to the S&P 500. For me, is really the golden standard. And that's why for myself, I will continue investing significant part into the S&P 500 just to have a base. And on top of it, I layer more risky assets on top, such as Bitcoin. Of course, I have real estate and some money in cash that I can use to capitalize on certain market opportunities. But I'm really interested to hear from you. What is your favorite thing to invest in? Let me know down in the comments below. I get back to every single one of you. Next up, check out this video over here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.